Rough. Fetch, Russell. Fetch. All right, guys. US 2000 USD on Oanda. For you guys not there, I think maybe dollar rut. I forget the ETF there. There's a whole bunch covering the US Russell 2000. And I checked out Russell. Russell seems to be small caps. And the thinking is when people start getting unsecure or insecure, they start moving away money from the small caps and putting them more in blue chips. As per Stan in his book, that's what he's noticed. So sometimes that's why he looked at the advanced declines or the high lows. Even if the index was the S&P or the Dow back in the days was still going up, he'd look at the underlining. If less and less stocks are making new highs or advancing, then he had a feeling that this divergence was money flowing out of the small caps and into IBM, GM, GE back in the days. So then after that, when those fell, the big blue chips fell. Then after that, it's timber. Okay, so we're going to use the Russell and see what's up with that. And maybe that could give us an indication of things to come. All right, monthly candle chart. All right, super duper. These highs right here. Not sure we're going to see those anytime soon. Monthly defined breakdown line. Already below. So December, unless we have a crazy wick like we had it right back here. But the difference now is that 12-month moving average, instead of being super strong and helping the case for a sideways move and continuation, all those bars coming in and then in a upwards trend in the stage 2. We've had this hard break below the 12-month moving average. We had the second month below it. So now it's starting to curve down. So we can't have that. There won't be that same pressure to bring that price action back up above that monthly defined breakdown line like we had back here. It could happen. There's still a few weeks left in December. So you could wait for the final chime of the end of the year before applying my chart trading framework to the monthly candle charts. And then after that, you get an apply measure move all the way to 1263. So a monthly close below 1500, 1510 brings me a target right here. And the symmetry is pretty nice because it brings me back to previous resistance and support, what I call a wall right here. And that's a nice clean target. It's not a greedy target that goes down years that you have to stay in and live through ups and downs. This is a nice, close, reachable target right there. So that's what it is on the monthly, man. So this is pretty clean cut. 12-month average is going to start going downwards. And the price action might bounce off here. And after that, you're going to be triggered out. But it could serve as, if you're still doing it stage 4, decline breakdown on the, or play on the weekly, you have to know that this support is going to be here. And then you might get a bounce off the 30 average and then go downwards. Okay. We're going to go check that out when we go on the weekly, guys. I'm just curious that, okay, this was the high. I'm going to overlay. I'm going to compare to the SPX. But I don't want to overlay in the chart. Compare to the overlay. Okay, let's overlay. Compared to the SPX. Wow. I just want to see back in 2008. Oh, I don't like that. Let me try again. Compare. Oh. SPX. Pat, what are you doing? Wasting precious minutes. Okay, there we go. Let's go back here. 2008. All right, here we go. And my breakdown line right about here. That's the big breakdown line. So there was actually a breakdown like we're seeing right now, close to these levels right here. That's the embryonic breakdown where the 12-month average is just starting to go down. That's where we are today. After that, you hit that monthly defined support or some support that's being defined, pull back all the way close to that 12-month average, never closing above it. And then after that, down it went with the rest of, in September, October 1st, down it went with the rest of the stocks when they had that harmonious leg down all together. World indexes, any index, any stock, everybody took pretty much a hit in October. That was like the nuclear bomb. All these are ninja swords, ninja fights, and then after that, okay, that's enough. Let's end it. Let's pop the bubble for good, and then the nuclear bomb exploded in October, and everybody had to leg down. Okay, let's change SPX. Let's the style. Let's put candles. Okay. All right. Okay, I don't have the 12-month moving average. There was a breakdown here from the top pattern. Another one here. Pull back to that previous support and resistance. And then down it went. So pretty much just a little bit. Oh man, they're pretty close to maybe 1 month before, barely. The price action of the Russel actually seems to follow a lot the SPX back in the days. So I don't know if any of the dynamics change. Russel seems to be just a little bit in advance, but they seem to, that correlation, guys, indication, compare. No, indicators, the correlation coefficient is awesome. Trading View, the bomb. If only they could get their act together and with the interactive broker and have that feed in, it'd be super duper. Oh, look at the correlation. So, yeah, the Russel for a long time has an almost perfect correlation with the SPX. So I guess that's what I should have been looking at. So if the Russell is going to break down or the SPX can break down, they're all going to break down together. Except here, I think the SPX was a little bit more resilient, dropped less than the Russell. Other than that, that correlation still following. All right, out you go. Out you go. Enough sidetrack. We have the Stan Weinstein to do weekly. Okay, ooh, red candles, I like it. So here I have my super duper red candles, increasing volume on those down days. What the hell's happening? Or out of the Ichimoku cloud. That's my monthly defined moving average. We're out of the Ichimoku cloud. We're below monthly defined support. We are below weekly defined support. 30-moving average going down, underperforming the SPX. Guys, you hear me all the time. This is my checklist or weight of evidence. Declining against the SPX, high red volume on those red days, sideways move here, close to that monthly defined and weekly defined support. The weight is too heavy, guys. Pullbacks are not happening. And remember, fear, panic. Fear is the fear of the unknown, and if you don't know if you're in the unknown, then panic could easily set in. You don't understand why it's going down. This is you're listening to the news, and then it's game over. So here, there's some weekly defined support. All right, so that's it. I have some weekly defined support. I have some monthly defined support, and those are zones that we could expect pullbacks. Maybe on that weekly defined, if it holds, then back to monthly defined support. And in this zone here could be a good area to enter short as a continuation short. Right here, if ever get back to these levels. And after that, you could observe how the volume behaves, if it's contracting on the pullback, and then another try to go down through that weekly and eventually that monthly and reach that target right here. If you played my classic chart trading framework on the monthly chart, or else if you're still in that stage 4 decline, if you haven't closed, if you're still making lower lows, if you're still below that 30-week moving average, if you're not violating any 4-point trend line, a break on the fourth is Stan took half his position out. It was signs that the stage 4 or stage 2 was starting to slow down. Until any of those exit points happen, exit warning signs, then you could ride this even further. So if it pierced through this monthly defined target, you could write it down to wherever it wants to go, guys. And I had fun on a few of my posts recently. Fibonacci, I used to do that, love it. It's a framework in itself, just that, Fibonacci. And I've noticed that often the levels and the targets I have on my monthly candle chart, swing rules, they fit nicely with these lines or close to. So if people are looking at Fibonacci, swing rules, that's why don't judge somebody else's framework. A lot of overlaps. As long as they have the risk and money management, they're good. So 38% retracement back to these 2016 previous resistance and support. And if you want to go down 50%, it then brings us to the lows. So that's the whole zone of congestion I call the wall, all the way to the natural support. And after that, if you want to go the golden ratio, then you're going all the way back almost close to those 2008 highs, guys. 900. And also those highs are previous. It's a previous resistance now turned support right here at this level. So those are the levels, guys, for Fibonacci retracement. Add that to the swing rules. Add that to stage 4 declines. Add that to everything you have in your pocket. You could play in confidence that you know with risk and money management. This is a potentially successful trade in the happening, guys. All right. Thanks for watching. Bye-bye. All right, guys. And thanks for subscribing. Appreciate it. Woof, woof. Bye, Russel. Fetch, fetch.